All right, gang. Good afternoon, good morning, good afternoon, good evening, wherever you are around the globe.
All right,
Welcome.
gang. Good afternoon, morning, good afternoon.
Welcome to our workshop today. My name is Steve Moses, and I am with the Pinnacle Institute. I'm the options specialist at Pinnacle, and I've been trading and educating on options for almost 20 years. Can't believe time flies as you're getting older. And we're going to talk about options and volatility today. But as you can see on the screen here, we do a lot of workshops on trading and investing, the Pinnacle method of supply and demand. I'll talk more about this at the end of the webinar if you have any interest in joining us in any of our workshops. Our next one is tomorrow morning. But today we're going to talk about options and volatility around earnings. Okay. Matter of fact, just give me a thumbs up if everybody can hear me, and hopefully we're in good shape. Oh, there we go. Okay, everybody's good, and so if you have any questions, put them in the chat box. Any questions, comments, thoughts, observations, um, put them in the chat box, and we're going to talk about volatility now. Um, if you want to share your experience with options, maybe you're a newbie, maybe you've been trading options successfully for a long time. That's cool. I have no problem talking for 45 minutes, an hour. I mean, we won't go more than an hour, but to talk about volatility and how we can use volatility to help in our trading. Now, I'm going to talk about volatility around earnings because we are just coming out of earnings season right now. I mean, there's still a few companies that'll have earnings over the next week or so, but the bulk of companies that have announced their earnings have been in the last 2, 3 weeks. You know, the big Amazons, Apples, Googles, Microsofts, Netflix, Teslas, all those. But there's still some companies coming out with earnings, and we're going to talk about the effect that earnings has on volatility. We're going to talk about what implied volatility is, because options are the only asset class where you can make or lose money without the stock moving. Okay. And depending on how new you are, options are the only, I mean, every other asset that you can trade, you are directional. You buy a stock, goes up, you make money, goes down, you lose money. You short a stock, it goes down, you make money, goes up, you lose money. You trade in real estate, goes up, you make money, goes down, you lose money. You buy a car, goes up in value, you make money, goes down, you lose money. Every other investment or trade that you have ever done, if you haven't traded options, is directional. Get the direction right, you make money, get the direction wrong, you lose money. Okay. But because options have not only expiration dates, but extrinsic value, that extrinsic value can inflate or deflate without the price of the asset moving, because the extrinsic value, the time value, people can have expectations, like, for example, the morning after an earnings announcement, of expectations of a big price move on the stock. So the stock doesn't have to move for people to have expectations of the price movement. Now, if you buy a stock and the stock doesn't move, you don't make or lose any money. But if you think the stock is going to make a move and you buy options to participate in that move in the future, the more options people buy, the more potential volatility there is on the stock. The stock doesn't have to move for the potential of future movement to grow. Does that make sense? Okay, and that's what we're going to start talking about. So let me just get through a couple of quick disclaimers here, guys. Anything and everything we do at Pinnacle involves risk. All trading has risk. Everything that we talk about today and going forward in Pinnacle is for information and educational purposes only, designed to make self-directed traders and investors better able to profit. And when I say profit, I also mean make more money when you're right and lose less when you're wrong. Okay. I'm not going to give any trade examples today because we're going to look at some past volatility from the last week or so around earnings, but to talk about how to take advantage of that and those potential moves in the future. All trading comes with risk. Okay. There is no such thing as a guaranteed profitable trade. I mean, come on. If there was such a thing as a trade that was guaranteed to throw off a profit, would I be here talking to you? I would back up the truck and just take out a home equity line and put every dollar I have into a trade that was guaranteed to make money, and that does not exist. So if you're a self-directed trader, you bear sole responsibility for your results, when to get in, when to get out. And one of the things that I'm proud of, our work at Pinnacle is we teach you how to lose less when you're wrong and make more when you're right. And volatility will help you do that. Okay. Because volatility can offset. If you get volatility right, it can even offset being wrong on the direction of a trade. Okay. All right. So, and by the way, the FTC says, like I just said, most day traders are not profitable. All right. And we've talked about why on past YouTube sessions, but, if you don't understand price action, it's going to be hard to trade profitably, because when you're a trader, you're either trading on where you expect price to go or where you expect price not to go. Okay, and that's a conversation for another day. But let's go to Thinkorswim. Now, I use Thinkorswim. I'm going to spend the rest of the webinar on the brokerage platform, and we're going to talk about volatility. And I am not recommending Thinkorswim. I've been using it for about 15 years. It's my favorite platform, but they're all pretty similar these days. You'll get live quotes, you'll get options change, you'll get everything you need, whether it's whatever broker you use. Okay, so if you're trading, you already have your broker. Which brokerage firm you use, to me, is irrelevant to your success. As long as you're getting live quotes and you're trading live, as long as you have good internet access, you have to know what you're doing. I've traded on multiple platforms over the years. Some of the ones I started on don't exist anymore, but as the technology has gotten better, it's better all around. As the internet has gotten better, it's better all around. But you still have to know what you're doing. You still have to understand price action and what makes the price of an asset go up or down, because that's the biggest reason traders lose money, is they don't understand price action. Okay. So what we're going to talk about today is volatility. Now, again, I'm going to take about a couple of minutes just to talk about options. Hello, everybody, people joining us. I'm going to talk about what an option is, and I'll take just a couple of minutes. I have a chart up here of IBM, okay, and just IBM. IBM is trading at 143 bucks a share right now. It's going to change as I'm talking, but it's trading at $143 a share. Now, if you want to buy IBM, you're going to pay $143 a share. If you're going to short IBM, you're going to short it at $143 a share. Okay. Whether you're buying it or shorting it is based on whether you're bullish or bearish, based on whether you're at supply or demand, based on whether you're at support and resistance, whatever rationale you use to get into your trades, whether it's fundamental, technical, doesn't matter. And we're not going to talk about that today. Okay. This is going to be a pure volatility conversation. But the stock is 143.16 as I'm speaking. That's the price of the stock because that's the price of the stock. The price of a stock cannot be inflated. I mean, you may think IBM's not worth $143 a share. Remember when those meme stocks, GME, what was it, GameStop and AMC, those stocks a couple of years ago, they went up like 500% in 3 days when all those YouTube, what was that little brokerage firm? The Robinhood traders were all trying to get in and out of that. Okay. So you may think the stock is not worth $500 a share for whatever reason. But the fact is, whether you think IBM is worth $143 a share, that's what it's trading for right now. And it's worth $143 a share because the last trade, IBM today has already traded 1.2 million shares. Okay. And the last trade that happened, somebody bought IBM at 143.18 and somebody sold it at 143.18. That's it. So the last two people to buy and sell IBM agreed that it was worth 143.18. That's it. Now, again, whether you think that's cheap or expensive is irrelevant. Whether you think it's overvalued or undervalued is irrelevant. If you're Warren Buffett and think it's undervalued, then you may want to buy the stock, but you'll only make money if the stock price goes up, and you'll lose money if the stock price goes down. Right? Right. Okay. So here is an option chain. Okay. Now, options are different than stock for a lot of reasons. First of all, there's only one IBM stock, and it's trading for 143.25. Right now, that's the price of IBM stock. There's only one stock. You're either buying it or selling it, buying it or shorting it. If you own it, you'll get a dividend, and whatever. That's it. Okay. But if you want to trade options, remember I just mentioned options have an expiration date. Okay. So let's open November options. They're more than 90 days out. Okay. Now you see these prices here, these strike prices. Think of them as supermarket coupons. You could buy IBM right now for $143. Okay. Goes up, you make money. Or you could buy, now let me ask you a question. Let's say you thought IBM was going all the way up here to 152. Okay. The stock is at 143. If IBM got to 152, how would you like to buy it for 140? I mean, let that sink in for a second. I mean, if you have a coupon for the supermarket, it says you could buy a bag of Doritos for 99 cents, and the bag of Doritos is $3.99. You don't pay $3.99, you pay 99 cents, right? Okay. Well, let's say IBM gets up here to 152. How would you like to buy IBM for 140? Well, you can't do that. A stock's trading at 152, you can't buy it at 140 unless, what if today we came down here and bought this 140 option, a call option? A call option gives you the right to buy a stock at that strike price, no matter how high it goes. Does that make sense? Just like if you have a 99-cent coupon to buy a bag of Doritos and you get to the store and Doritos are priced at $3.99, you don't have to buy them for $3.99, you buy them for 99 cents. Okay. Well, what if IBM gets to 152? You don't have to buy it for 152 if you have a coupon, except coupons are called options in our world. So let's say we bought this option right now, and I'm going to click right here. We could buy this 140 option for $8.35. Okay. Now, options are sold in contracts, and each contract gives you the right to buy 100 shares of stock. So one of the benefits of options is leverage. If you wanted to buy 100 shares of IBM stock right now at 143 bucks a share, it would cost you $14,300. Now that's a lot or a little depending on the size of your account, doesn't matter. Okay? Hopefully, if you're buying 100 shares of stock for 14,300 bucks, you have appropriate money management rules. You're not putting 90% of your account in one trade. Separate conversation. So you could spend $14,300 right now to buy 100 shares of stock. Or if an option cost $8.35, but it gives you the right to buy 100 shares, that option would cost you $835. Wow. So $14,300 to buy 100 shares of stock, $835 for the right to buy 100 shares of stock. Does that make sense? Are you with me? Now, you're not just buying the right to buy 100 shares of stock. You're buying the right to buy 100 shares of IBM at 140. And you get to do that no matter how high IBM goes until November 17th. Because this option expires on November 17th, just like your supermarket coupon, say, expires on Friday night. You have the right to buy a bag of Doritos for 99 cents until tonight when the store closes at midnight. And if the bag is $5 when you get to the store, you get to buy it for 99 cents, right? Right. Okay. Now, so $835 for the right to buy 100 shares, or 14,300 to buy 100 shares. So some of you are thinking, wow, why would somebody buy stock if you could buy options? And I always ask myself that question anyway. But here's the first answer. First of all, if you buy IBM stock, how high can IBM go? How long can you own IBM stock for? The answer is forever. Well, the answer really is as long as it stays a publicly traded company. Now, IBM has been publicly traded since what, the 30s or the 40s, 1930s, 1940s. GE has been a publicly traded stock in this country since 1903. They were one of the original Dow Jones stocks when Mr. Dow and Mr. Jones created the Dow Jones Index with only 13 stocks in it 120 years ago. So, profit or loss notwithstanding, your family could have owned shares of GE for 120 years. Now, some companies do go out of business or they get bought out or whatever, whatever, whatever. But so theoretically, you could own a stock forever. And chances are IBM is not going out of business anytime soon. Okay. But it also doesn't have an expiration date. You buy 100 shares of stock and you can own it as long as you want. But if you buy this call option for only $835, you also have the right to buy IBM stock at $140, no matter how high it goes, but only until November 17th, not forever. Now, if you think it's going to take longer for IBM to go up, you could go further out. You could go all the way out to January of 2025, and you could buy a 140 call option expiring in a year and a half. Now, this is going to cost you more than $8. This is going to cost you about $16.50, $17 because you're literally buying more time. See, options have an expiration date. So options have what are called intrinsic value and extrinsic value. Extrinsic value is also referred to as time value. So instead of buying a November 23 option where you're only paying for 98 days, you can go out to January of 25 and you can buy the same 140 call option, giving you the right to buy the stock at 140, but you have that right for 525 days, for a year and a half. Okay? Now, why would somebody buy 525 days as opposed to 98? Well, how many of you have owned stock for a few years? You could think, what if you think a stock is poised to go up for the next couple of years? If you buy an option that expires in 3 months, then you only get to participate in its movement for the next 3 months. But if you buy an option that expires in a year and a half, then you get to participate longer. Just like stock. I mean, I have met members at Pinnacle who've owned stock for over 10 years. I met a guy a few years ago who bought Microsoft stock when it went public in the mid 80s and still owns it, has never sold it. So, if he was telling me the truth, he's up a ton because the stock has obviously done well. It's split 7 or 8 times. So if you bought 100 shares 35 years ago, you probably have close to 15 or 20,000 shares now just from all the stock splits. I mean, the stock has gone up and down, got hurt during the dot-com crash, got hurt in 2008, got hurt maybe during COVID. But, if he's held on to it for 35 years, he's gotten dividends for 35 years, and the stock is split. So that's one advantage to stock ownership. Okay. But here's the thing. We're here to talk about volatility today. So let's go back to November, and we're going to look to buy an option expiring in more than 90 days. And if we buy this 140 call option, now let me explain about intrinsic value. Okay. You have a stock trading at 143.25. And yet here's a coupon giving you the right to buy the stock at 140. So if you paid $3.25 for the right to buy IBM at 140, you would get it at 143.25. This coupon, here is the column called intrinsic value right here. This option is only worth $3.23 intrinsically. Then why are we paying $8.35 for it? Because the extrinsic column, we're paying $5.03 for the next 98 days. I mean, think about it. If you're going to spend $835 for the right to buy the shares instead of $14,300, there's got to be a downside. And the downside is, if you could buy a call option for $835 and it never expired, who would ever buy stock? Does that make sense? So you have the right to buy IBM at 140 for the next 98 days, no matter how high it goes. Now, If IBM gets to 152.50, and we have a coupon that says we can buy it for 140. If IBM gets to 152.50 and we have the right to buy it for 140, that call option or that coupon has to be worth $12.50. What do we pay for it? $8.35. So if you bought something for $8.35 and sold it for $12.50, you got about a 50% rate of return. You made $4.15 profit on your $8.35 investment. That's a 50% rate of return on a stock that went up less than 10%. Because if the stock only goes from 143 to 152, it only went up 11 points. 10% would be 14 points. So the stock only moved about 8%, and yet we could make 50% on our option. That's another benefit of options. So the first benefit was leverage, $835 versus $14,300. The second benefit is much better rates of return if you're right. Now, I know rates of return gets kind of sticky. I mean, we don't pay our bills with rates of return. If you're trading for cash flow or income, you pay your bills with profit, not with rates of return. Okay. But if you've got a small account and you're looking to grow a small account, I mean, first of all, you could buy one call option for $835 in an account that might not be big enough to buy 100 shares of IBM stock. I mean, if you have a $10,000 account, you can't buy 100 shares of IBM stock. If you have a $10,000 account, you could buy it on margin, but we're not going to talk about buying stock on margin today. And you're paying interest and you're doing other stuff. Okay? Does that make sense? All right. So the second benefit is a great rate of return. But here's the thing. As I've showed you, so let's come back to here. Here's your intrinsic and extrinsic column. Why are we paying $835 for something that's only worth $325? Why are we paying an extra $5? And where did that $5 of extrinsic value comes from? That's called implied volatility. And if you've never heard of it, options are the only asset class that has implied volatility. And simply put, volatility is measuring the expectations of future stock movement. Okay, now think about this. If you think IBM, let's go back to this day right here. Look over here. If you were looking at this chart on this day and IBM comes down to a demand area, it's at 115, and you think it's going up. Whether it's support, whether it's resistance, whether it's a Fibonacci retracement or a Bollinger Band, again, whether Kramer threw a chair at the screen and went booyah. If you're buying shares of stock because you're bullish, okay? So if you think the stock is going up from 115, you buy it. And if the stock goes from 115 to 140, you're going to make $25 a share. But remember, again, the stock has to go up to make the profit. Okay? Now, if you're going to buy 100 shares at 115, it's going to cost you $11,500. Okay. But if we buy a call option because we think the stock is going up, what if everybody thinks the stock is going up? Then they're going to want to buy call options. So who's at risk when we buy a call option? What does somebody else have to do? Somebody else has to sell us the call option. And they're taking on a lot of risk. Why? Because when you buy a call option, you're buying the right to buy the stock at that price, no matter how high it goes. So again, let's say you're buying a down here at 115, you're buying a 115 call option because you want the right to buy IBM at 115 if it goes all the way back to 140. Are you with me? Okay. Well, if the stock gets to 140, why do you get to buy it at 115? You know why? Because the call option we bought, somebody sold us. Somebody had to sell a 115 call option for us to buy a 115 call option, right? Every trade has a winner and a loser and a buyer and a seller. Pretty simple. So when you buy a call option, you're buying the right to buy a stock at that price, no matter how high it goes. When you sell a call option, you're taking on an obligation, you're selling an option, you're collecting a premium, and you are taking on an obligation to sell the stock at that price. So if we're buying a 115 call option because we think the stock's going up, we have the right to buy the stock at 115 no matter how high it goes. The person who sold us the call option has to sell us IBM at 115 no matter how high it goes. So you know why? If the stock gets to 140, we can buy it at 115? Because if the stock gets to 140, somebody's got to buy the stock at 140 and sell it to us at 115. Sucks to be them. The home run we're looking to hit, someone else has to give it up. Does that make sense? So the sellers of options are taking on risk. Think of an insurance company. When they sell you a policy, they take on risk, right? You're buying car insurance, the risk is you don't crack up your car. Homeowners insurance, the risk is your house doesn't burn to the ground. Health insurance, the risk is you don't die or get hurt, whatever. Make sense? So that's why insurance companies do their due diligence. You want car insurance? Give me your driving record. How many tickets? How many accidents? Any DUIs? You want health insurance? What's your cholesterol? What's your blood pressure? Do you smoke? Blah, 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 right? That's why the higher the risk, the higher the premium they charge you, right? So the best example I've ever come up with about volatility, think about you have a house in Florida on the beach. Okay. And let's just use $1 million for easy math. It's $1 million house on the beach in Fort Lauderdale. Well, boys and girls, we're coming up to hurricane season. Okay. You're going to pay a certain amount of premium for a house on the beach in Florida because every year there's hurricane season. Okay. What if one day you turn on the Weather Channel and you see a really, 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 really big white cloud with an eye in the middle of it coming right to Fort Lauderdale? What is the hurricane risk now? It has gone up, right? What's going to happen to the insurance premiums? They're going to inflate, right? So when the sellers of insurance feel that their risk profile is going up, they will inflate the premiums they charge to mitigate as much as possible some of the risk. Well, option sellers will do the same thing. If you want to buy a call option, someone's got to sell it to you. And if everybody thinks the stock's going up, then the seller of those call options is taking on a risk to have to buy the stock a lot higher to sell it to you at a lower price. So the more that everybody thinks the stock is going up, the sellers of those call options will inflate the premium. And you can only inflate the extrinsic value because the intrinsic value is based on the stock price. The stock price is the stock price because it's the stock price. In the last 10 minutes while I'm talking, IBM stock has gone up 15 cents. Why? Because somebody agreed to pay 15 cents more for the shares and somebody agreed to sell them for 15 cents higher. Well, who knows why? I don't care. Okay? But that's the price. But when we come to the option chain and we come back here and we want to buy a 140 call option, well, that's now gone up from $8.35 to $8.40. So as the stock has gone up 15 cents, the option has gone up a nickel. Okay, now the title for today is Volatility Around Earnings. So let me show you something. Let's go to Netflix. Okay, a company everybody loves to hate, but all right, whatever. So you see these little blue dots here? Companies announce earnings every quarter, every 3 months, every 90 days. Okay, now down here, you see it says implied volatility. So this green line is measuring the implied volatility of Netflix's options on any given day. Now you may notice this looks like what is it? The EKG at the hospital, goes up, boom, goes up, boom, beep, beep, beep. Okay. Notice when the green line drops like the Titanic right after earnings. Now, what can happen the day after a company announces earnings? Stocks can gap up or down big, right? Now, not every stock has the propensity to do that, but Netflix, Apple, Amazon, Google, Tesla, Microsoft. I mean, just there are some stocks that are a lot more volatile than others. But notice what happens in the approximate 2 months before the earnings announcement. Look at the green line. Now, this is the implied volatility. Okay. Now, theoretically, if the stock flatlined, and stocks don't flatline for 6 weeks, obviously, but let's just humor me for a second. Let's say the price of this stock, right here we are. Let's look at, I mean, the stock here did kind of flatline from what are we here? July 28th to October 17th. For 10 weeks, this stock traded between 215 and 244. It traded within 30-point range for almost 10 weeks. So basically, right here on July 25th, the stock was trading at 231. And here we are on October 13th, it's trading at 231. It went up a little, down a little, up, but 10 weeks later, it's at the same price. So if you bought the stock and 10 weeks later, the stock is in the same place, that's called break even. No harm, no foul, right? But look at this. Look what happened here from August 12th, when the stock was at 250, to October 14th, when the stock was at 250. Look what the volatility did. The volatility went up almost 100%. Now, what does that mean to you? Well, what volatility measures, okay, it measures the premium that people are willing to pay for the option, whether they want to exercise the option and buy the stock or not. Volatility. So if volatility is inflated, I mean, guys, think about it. God forbid what's going on in Hawaii today. If you were selling bottled water, what would the price of water and plywood and services be in Hawaii today? The price is going to go up. Supply and demand, right? I mean, I'm just saying. So as implied volatility is going up. Now, why would implied volatility be going up? Because what could Netflix do? What could Netflix stock do the day after they announce an earnings announcement? Well, first of all, let's go back here about a year and a half ago. This was January of 22. Netflix closed here at $507 a share. It opened the next morning at $400 a share. Ouch! It dropped over 100 points or 20%. That's huge. All on an earnings announcement. The earnings estimate was 80. And by the way, they beat the estimate by over 50%. The earnings estimate was 81 cents a share. They reported earnings of $1.33. Why did the stock tank? Well, I don't know why right now, but I'm sure it had something to do with their guidance going forward. Maybe they were losing subscribers. Maybe the previous 90 days was good, but they say going forward, it doesn't look so good. Doesn't matter what the reason is. So it dropped 100 points or 20%. Let's fast forward 90 days later, the next earnings announcement. Stock closed the day before at 350. It opened at 245. Now it dropped another 105 points, but this time it dropped almost 30% on earnings, of which they beat the estimate by about 20%. But notice what happens to the green line leading up to earnings. Remember, implied volatility is measuring, okay, the expected future move of a stock. the expected future move, or rather, the expected magnitude of a future move. Now, that future move could be up or down. Volatility doesn't measure direction, and it doesn't measure bullish or bearish. But if you know, based on history, based on the historical volatility of the stock, that it has a propensity to gap up or down after earnings. Well, that's what you're seeing reflected in this implied volatility inflating. Now, why is this important? Because let's look over here. This earnings announcement was on April 19th. Here we were on March 15th. The stock was in the same place, okay? Except the volatility, again, the volatility went up about 50%. It inflated 50%, which means if you had call options over here when the stock was at 340, and a month later the stock is still at 340, but volatility inflated 50%, that option premium is now going to cost more than it did a month ago, even though the stock price didn't move. If you bought the stock a month ago at 345, and a month later the stock is at 345, no harm, no foul, you broke even. But if you bought a call option here when the stock was at 345, and a month later you still own the call option, hasn't expired yet, and the stock is still at 345, that call option will have inflated. That extrinsic value I showed you would have inflated. So you could sell your call option for a profit even though the stock price didn't move, because the value of the option's time value inflated. Does that make sense? And just to be fair, if it's confusing you a little bit, this is the hardest thing for new options traders to wrap their head around. Volatility. You know why? Because you can't see volatility. I mean, you can see it if you have if you put this gauge on your chart, and every broker will give you access to measuring implied volatility. It's not a state secret volatility, but you have to know how to gauge it. Is it high because it's getting higher, or is it high but it's actually going lower? It's getting lower. What trend is volatility in? Okay. If I tell you the implied volatility of Netflix's options is 50, what does that mean? It means nothing to you out of context. Is it 50 but it was at 30 2 days ago and it's inflating? Or is it 50 because it was at 70 2 days ago and it's deflating? But just remember this. Here's why volatility is so important. How do you make money in America or any country? Anything you buy, you need to sell for more than you paid for it, right? Anything you buy, the price has to go up and you need to sell it for more than you paid for it. Anything you sell short, you need to buy it back for less than you sold it for. You need the price to go down. Okay, well, if you're trading stock, futures, Forex, cars, real estate, doesn't matter. The price of the asset needs to move. Options are the only asset class where you don't need the price of the asset to move. You need the expectation of future price movement on the asset. Because the more people who are buying, so if leading up to Netflix's earnings, what does everybody understand back here in March? Man, last time they had earnings, stock gapped down 100 points the next day. Wow. So we could see a big move after earnings, which was here. Earnings were on April 19th. Okay. So in the month leading up to April 19th, everybody knows when the earnings announcement date is. But what they don't know is what is the announcement going to be and what is Wall Street's reaction to those earnings. Nobody knows. But if you had bought options a month before this earnings announcement, Now, look, obviously, if you bought call options and the stock dropped in that month, you would have lost money because a call option is still a directional asset. You're buying a call option, which gives you the right to buy a stock. So if you buy a call option, the stock goes down, you're going to lose money directionally. But what I'm talking about now, see, one of the cool things about options is you can be wrong directionally and make a profit because of volatility. You can actually sell what we call out of the money options. They have no intrinsic value. Let me show you something. Let's go back to Netflix. Okay. So here's Netflix today. It's trading at 4.24. It's down about $6. So let's go out 90 days. All right. So let's go out to November. Netflix is trading at 4.24. Here are all your coupons on Netflix. Now, again, if you want to buy Netflix right now, it's going to cost you $423 a share, $42,300. Okay, that's again a lot or a little. Well, here's a $500 call option on Netflix. Well, wait a second. A $500 call option, if you buy it, gives you the right to buy Netflix at $500. Who's buying that today? Why would somebody buy a call option, giving them the right to buy Netflix at 500 if they could buy Netflix stock today at 423? And they're not only buying Netflix at 500, they're paying $11.20 a share for the right to buy Netflix at 500. Does that make sense? Somebody who obviously thinks Netflix is going above 500 in the next 98 days. Does that make sense? Now, why they think that is not my problem. The only reason somebody would buy that call option, and let's take a look at today's volume. Okay. So let's look at this $500. Look at this. 13 contracts have traded today. 624 contracts are open on this $500 call option expiring in November. Now, at some point in the past, Netflix stock has traded over 500. So maybe somebody thinks Netflix is going to fill this gap. Maybe somebody thinks Netflix is going back to 600. I don't know why somebody would want to buy a 500 call option, but it's only going to cost them $11. Now, let me ask you a question. What if they're going to buy a 500 call option today because they think Netflix is going to 600? If Netflix goes to 600 up here and you have the right to buy it at 500, that option now has to be worth 100, and you could buy it today for 11 and sell it for 100 if it gets to 600, which there's no guarantee that's going to happen, and there's no guarantee it's going to happen by November, in 98 days. But if it did, that would be 1,000% rate of return. You buy something for 10 or 11 bucks and you sell it for over 100. That's a home run trade. But here's the thing. What if instead of buying a 500 call option, we sold it today for $11? We just clicked this button and we sold this option for $10.85. Now, why would we do that? So remember I just said options are the only asset class where you can make or lose money when nothing happens. So I just showed you Netflix where the stock was in the same place a month later. Okay, here, look at this. Let's look right here. June 9th, 2 months ago, Netflix was trading right here at 423, 8 weeks ago. Okay, what if we sold a 500 call option 8 weeks ago? The stock has not gotten to 500. But what if we sold a 500 option that expired in, say, a month? That option would expire worthless if Netflix stays under 500. So let's do this. Let's do this right now. Let's go out 1 month, not 3 months. Let's go out 30 days. Let's go out 35 days to September, and let's sell a 500 call option. Now, this one's only trading for $1, okay, because it's only 1 month instead of 3. But here's how you could make money in the options world. If we sold this option today for $1.10, okay, That dollar, we'd get to keep $110 per contract in 35 days if IBM closes under 500. Well, the stock is only trading at 423. What has to happen for the stock to stay under 500 in 35 days? Nothing. The stock's already under 500, right? So if we sold this option right now, and have any of you ever sold a stock short? I know there's risk to the upside. If you sell a stock short, you have risk to the upside. If you sell a naked call option, you have unlimited risk to the upside. Okay, some of you do that. But think about it. If you short a stock, the stock has to go down to make a profit, and you lose money if it goes up. We could sell this option right now, collect $1.10 or $110 per contract. And the stock has to do nothing for 35 days except stay under 500. So if the stock goes down, is it under 500? Yes. If the stock goes sideways in the next 35 days, is it under 500? Yes. Could the stock go up 76 points and still be under 500? Yes. So you would keep the $1.10 if the stock went down, sideways, or even up 15%. You could make $1.10. Now, I'm not saying whether that's a good trade or a bad trade, or whether you would do that only for $1. I'm just sharing the concept that we're selling time. If we're selling this $500 option, it has zero intrinsic value. Zero. Okay? A $500 call option is worthless intrinsically. All we're selling is 35 days of time. This is the only asset class that you can even do that you can sell or buy something that's worthless. If a stock goes to zero, you can't buy it. It's at zero. You can't. If your stock already goes to zero, if you own stock, Bear Stearns or Lehman Brothers years ago, and it goes to zero, you can't sell a stock at zero. So options are the only asset class that you can buy and sell stuff that is worthless. Okay? Now, this extrinsic value, all of this premium is time. But if the expectation of future price movement starts to go up, this is going to inflate. Just like if you want to buy homeowners insurance when you know the hurricane is coming. Does that make sense? Let me ask you a question, guys. You can answer this in the chat if you want. When is the best, and listen to this question carefully. When is the best time to buy insurance? Now, I know what everybody's going to want to say, but I didn't ask you when is the best time to have insurance. Obviously, look, the answer to both. The best time to have and buy insurance is before the accident, before you need it. The best time to have insurance is before you need it. The best time to buy insurance is before the insurance company knows you need it. Because once the insurance company knows you need it, what happens to the premium? What happens to their perceived risk? It is going up. It is inflating. What will they do with the premium? They will inflate it. That's why if you go for life insurance and you're older, or if you go for life insurance and you smoke, or if you go for car insurance and you've got 10 tickets or 2 DUIs, you're going to pay a lot more premium. Look, you could be 65 years old, never gotten a ticket, never had an accident in your life. But that doesn't mean you're not going to have one tomorrow. And they're going to give you the best premium they could for your age, for where you live, and for your driving record, whatever. Okay. Premiums will never be zero because an insurance company is in business, to sell insurance and to hopefully not have to pay out. Okay. So with the insurance companies, if you're unhealthy, it raises their risk. If you have DUIs, it raises their risk. Well, when there are option sellers, the due diligence of option sellers is not your driving record or your health record. If someone's going to sell you an option, they would like to sell it at a point where they don't think the stock is going to go. So when you buy insurance, do you ever really hope to file a claim? No, you don't want to file a claim. You don't want to have you don't want to sit there and go, gee, I bought car insurance. It expires the end of next week. I better hurry up and get into an accident so I can use it. No, you buy insurance for peace of mind. You buy insurance so you can sleep at night. You buy insurance, you hope you don't have an accident. The insurance company sells it to you. They certainly hope you don't have an accident. And by the way, how does an insurance company make money? Buying insurance or selling insurance? Selling. They sell you a policy, they collect a premium, and if nothing happens, what? They give you the premium back? No. They keep the premium and they sell you another policy. So when you sell options, guess what? If we're selling a $500 call option on Netflix, our due diligence says the probability of this stock getting to 500 in the next 35 days is slim. I'll sell you that option for $1.10. And if the stock doesn't get there, the stock goes sideways down or even up 15%, I still keep the $1.15. Now, let's go back to earnings and how to use volatility around earnings, or how to be aware of volatility before earnings, because volatility giveth and volatility taketh. Look down here at this green line. It's not, now, first thing I mentioned was in the 8 weeks or so before earnings, what does volatility do? It inflates right up to the earnings date. Because while the earnings date is a known date on the calendar, the earnings announcement is unknown, and the reaction to that earnings is unknown. But on the morning after the earnings announcement, the unknown is now known. So on the morning, look what happens to implied volatility the morning after earnings. Whoosh, whoosh, whoosh. If I didn't even see these blue things here, I know when the earnings dates are. Boom, 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 and boom. Now, post earnings are not the only thing that will deflate an earnings, that will deflate implied volatility, but it's certainly most likely to do so. And by the way, it's not a guarantee that the volatility will deflate the morning after an earnings announcement. It's a very, very, very high probability. Okay. I'm not going to put a number on it, but a very high probability. Now, I just mentioned if you bought call options here and a month later the stock was in the same place, but volatility inflated, you can sell your option for more than you paid for it, make a profit, and the stock didn't move. But remember, volatility giveth and volatility taketh. So, what if you bought options right here and the stock didn't gap up or down a lot? And the next morning, the volatility dropped almost 50%. That giant sucking sound you hear is the inflated extrinsic value of your option getting sucked out of that premium. Let's say you bought call out. Let's say you didn't understand volatility. And the day before this earnings announcement, you expected the stock to gap up big or just to move up big the next day. Well, I'll tell you right now, right here, the stock closed right here at 202. It opened the next day at 216. It only gapped up 14 points. No, I'm sorry. It gapped up right here. It only gapped up 5 points. But the volatility dropped 50%. You know what that means? You could have bought a, now remember what I told you what a call option is. Let's say the day before earnings right here, when the stock was at 200, you bought a 200 call option. But if the volatility is up here and you buy this call option the day before earnings, you're buying hurricane insurance when the wind is already blowing the roof off your house. Okay? Wow. So at the end of the day, if you're buying an option here, you're buying a very, very, very inflated option. The stock went up, but more volatility came. The stock only went up 5 points at the open. So this is one of those cases where if you bought call options here, the stock went up, you're thinking you're going to make a profit, but the implied volatility got sucked out. So you could have bought call options, the stock went up, and you could have taken a loss. And that's why people think options are risky. Because look, if all you just did was buy the book Options for Dummies, which is not a bad book, by the way, it's not a terrible book. It's pretty basic, but and if you just knew a little bit about options and you went, gee, if I buy a call option and the stock goes up, I'm going to make money. Well, no, not necessarily. You have to understand strike prices, in the money, out of the money, expiration dates, extrinsic value, inflated premium, deflated premium. Because I've said options are amazing. I think options are the greatest thing ever invented after single malt scotch. Why? Because it's the one asset class where you can be wrong directionally and make a profit. However, if you can be wrong directionally and make a profit, that means you can be right directionally and take a loss. This is the only asset class that can say that. You buy a stock, it goes up a penny, you're in the black. I mean, commissions notwithstanding and whatever. You're not up a lot, but you buy a stock, it goes up a penny, you're profitable. You buy a stock, it goes down a penny, you're starting to take a loss, small loss. Okay? And remember, we could sell a 500 call option today on Netflix. The stock could go up 75 points and we could make a profit. It could go down to zero, sideways, or even up. So it's also the only asset class where you can profit in all three directions. But here's why it's so important to understand volatility. When you get your driver's license at 16, you're learning the car. Stopping and starting and braking and turning and reading the signs and speed limits and blah, 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 blah. But if you learn how to drive in July on a nice sunny day, dry roads, you're just learning how to drive. But if you live in the Northeast and you're driving in January and it's 20 degrees and it's sleeting outside and there's slush on the road and maybe dry ice, it's not just enough to know how to drive. You need to know how to handle the weather conditions. Think of volatility as the weather conditions you're trading options in. It's not just enough to understand calls and puts. It's not just enough to say, well, I'm buying a call option, the stock goes up, I'm going to make some money. Not if you bought very, very, very inflated options. Because I'll tell you right now, there are people who just trade volatility. I'm one of them. I'm primarily a seller of options. I want to sell options out of the money, below demand, above supply, where I don't think the stock is going to go. And I love selling inflated volatility. But what if you sold options the day before earnings and the next day the stock did nothing? It opened in the same place. Those inflated option premiums are going to deflate, allowing you to buy them back for less than you sold them for without the stock moving. Now, there's no guarantee the stock is going to open tomorrow or it closed today. That's the part of trading. Okay. Does that make sense, everybody? We're going to wrap this up in a minute. So what I'm trying to show you here is, if you look, stock traders have it easy, with all due respect. You're directional. If you're at demand, you're buying the stock, you think it's going up. You're at supply, you're shorting the stock, you think it's going down. That's it. And what do if this was your demand zone and this was your supply zone? If you're down here at demand, you're bullish, you think it's going up. If you're up here at supply, you're bearish, you think it's going down. Okay, what do you do in the middle? Nothing. I used to work with a woman who said, don't diddle in the middle. Okay? Well, options are the only asset class that you can diddle a little in the middle. All right? Because you can sell options where the stock isn't, and you're selling time value. And what you want to learn how to do is sell inflated premium and buy it back when it deflates, or buy deflated premium and sell it for more than you paid for it after it inflates. I mean, look, you can still enter options trades where you have to be right directionally. Don't get me wrong. If you bought call options here and IBM stock dropped 50 points, you're gonna, forget volatility. You're gonna take a bath. It's like buying a stock, drops 100 points. Now rising volatility will offset some of that loss, but if you're really wrong directionally, you're gonna take a hit. But what I want you to see is look at this here. Leading up to earnings, look what volatility is doing. You have to understand how that affects your option premium regardless of stock movement. And on the day and the week after earnings, deflating volatility, how does that affect your options premium? Now, let me ask you a question. Is inflating options premium a good thing or a bad thing? Is deflating options premium a good thing or a bad thing? The answer is yes. Well, actually, the answer is it depends on what you did. If you bought really, really inflated options, then all of this deflation is hurting you. Okay. If you sold really, really deflated options and then the volatility is inflating them, you may have to buy them back for more than you sold them for. Uh-oh. You can't trade options without understanding the road conditions, without understanding volatility. And the reason we talked about earnings is because look, stocks that are historically volatile, look what happens in the lead up to earnings and right after. The lead up, right after. The lead, and you could chart this. The 2 months or so before earnings, volatility will inflate. Boom. Volatility will inflate. Boom. Volatility will inflate. Boom. Volatility will inflate. Boom. Now, sometimes it doesn't inflate as much. Inflated a lot here, inflated even more here. It inflated here and then stopped inflating for a while. That will happen. But what will almost always happen is not so much the inflation in advance, but the deflation after earnings. And remember, it doesn't matter if the stock gaps down or gaps up the morning after. So here's a case, the last earnings last month, Netflix, again, beat the estimate. The stock closed up here at 477. It opened at gap down 30 points, and the volatility still deflated. So just because you see the volatility deflating, that doesn't tell you the directional move that the stock made. That tells you the expectations of future stock movement is changing. That's all it tells you. And just like you really can't drive without respecting and knowing what the road conditions are, I don't know how you can trade options without understanding volatility. Because look, under normal times, when volatility is normal and it's at the mean, it's in the median, it's in the middle. If you're right directionally, great, you should make money. If you're wrong directionally, you should lose money. I get that. But if you don't understand, like during COVID, February and March of 20, during the dot-com crash, during the subprime mess in 2018. Let's go back to the SPY, the ETF on the S&P, and let's go back to COVID. All right, let's go back to March of 20. All right, look at this. This was COVID, February and March of 20, and look what happened to the options on the SPY. Wow. So even buying call options down here, oh my goodness. I mean, this was as high as volatility had been since almost the subprime mess of 2008. And then immediately, boom. How about that's Netflix. I wanted to see SPY. Sorry, SPY will be same thing. Yeah, look at that. See, there we go. Same thing happened with Netflix though. As the SPY dropped 30%, look at the volatility. And then as the market started going back up, volatility starts to go back down. This was not earnings on a stock, but this is what volatility tends to do. Volatility tends to inflate as price is dropping, and volatility tends to deflate as prices rally. Okay. And then on a particular stock, it's more about the unknown earnings announcement date and the reaction to that. Okay. Look, if you got any more questions about that, come join us at Pinnacle. All right. We've got, like I said, we've got workshops coming up. I've been with Pinnacle for a handful of years. I'm the options specialist there. Sam Seiden founded Pinnacle, the Pinnacle method of supply and demand. So much of what I talked about today was based on where do you think the stock is going? Or like selling those Netflix options, where do you think the stock is not going? Okay. I mean, everybody who trades, to some degree, you're trying to time the market and you're trying to make a prediction. I know we've been told you can't time the market. Well, I don't agree with that. I think you can if you understand price action. You can't time it to the penny, and you certainly can't time it to a guarantee because things change. But if you understand price action and what makes the price of an asset go up or down, that order flow imbalance, not MACDs and stochastics, lagging indicators from 2, 3, 4 weeks ago, then you can understand why would somebody want to buy an option at supply. See, when I say sellers of options sell where they think they're going to do their due diligence, they're going to sell options. When I sell options, I sell options where I don't think the stock will go, and I will never have to fulfill my obligation. Just like the insurance company selling policies that they don't think they will have to pay out on. You're 35 years old, you want life insurance, you don't smoke, you don't drink, you got no cholesterol, you got no blood pressure, you exercise, blah, 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 blah. They want to insure you because the probability is they will not have to pay out. You're 45 years old, your cholesterol is 400, your blood pressure is 200 over 180, you smoke 2 packs of cigarettes a day, you haven't gotten off the couch in 20 years, good luck, okay? So anyway, it's all about expectation. And the reason we can have expectation is because we understand price movement. Where's price going? Where's price not going? That's the Pinnacle method of supply and demand. Join us tomorrow morning or next Wednesday or next Saturday as we go through the Pinnacle method of supply and demand, order flow imbalance, and greatly increasing your probabilities of being able to time the market for either directional trades, non-directional trades. But here's the goal of trading, and I'll leave you with this. Losses happen. The secret to your success as a trader is not what you make when you're right. Winning trades take care of themselves. It's what you don't lose when you're wrong. Because you will have losing trades. I like to say give up field goals when you're wrong, give up 3-point field goals when you're wrong, and score 7-point touchdowns when you're right. You give up 4 field goals, they only scored 12 points. You only need to score twice if they're touchdowns. They outscored you 4-2. You outpointed them 14-12. You win the game. Nobody cares how many times they scored. We care how many points they score. Take small losses. Learn to love small losses. And when you sell options, if you understand volatility and you get to sell options, you can even be wrong and still make a profit. You can get stopped out of options trades for a profit. It is possible to do that. Okay, we'll talk more about that in our workshops. The link to any of these workshops is in the chat box. We have one tomorrow, Wednesday, and Saturday. Thanks for coming out this morning or this afternoon or this evening, depending on where you are from around the globe. I'm in Napa Valley, California, so I'll probably going off and do some wine tasting this afternoon after the market closes. Thanks for joining me here today. Hope to see you in any of our upcoming workshops or on future YouTube sessions. I do a YouTube session on options every month. Look for us at some point in September. But I do an option session every month on YouTube. Thanks again for joining us, guys. Great having you here. Good luck in your trading and in life. And hope to see you soon and in any of our workshops. Bye-bye.